Hey, it's Greg here. So first, props on being here, because if you are here, you want to be better with your money and learn how to invest. Having a more stable financial future and a better financial future simply can be had by investing, and investing early and often. So to answer the question of when you should start investing, I am saying today. Today is the best time to start investing, and I'm going to break down why in this video, and I'm also going to break down my favorite avenues for investing. So if I started investing at 20 years old and I wanted to retire at 60, if I put $10,000 away every single year from the age of 20 to 60, I would have put down $400,000. Now, if I decided to wait until I was 40 to start investing, and instead of putting $10,000 down, I put $20,000 down. So from the ages of 40 to 60, I also put $400,000 down. I would be investing the same amount, but the outcome is crazy different. So let's say my annual rate of return is 8% in both instances. When I put down $10,000 every single year for 40 years, my nest egg at the end of it is right around $2.8 million. Now, if I waited until I was 40, put $20,000 down every single year and still earned 8%, my nest egg at the end of those 20 years is actually around $1 million. So just starting early can be the difference of $1.8 million, and it is the same exact amount of money that's getting put down. So start investing early. My name is Greg Acton. I'm a CPA, and I want to help as many people as possible be better with their finances and to start investing. So if you could do me a favor, hit that subscribe button and share this video with a friend. I would like to reach 100,000 subscribers by the end of 2021. Now, you may be nervous saying, well, what if I buy into the stock market right now and it tanks tomorrow and we go into this depression? What happens then? Now, I get why you're worried about it, and this is where you have to determine what level of risk you are willing to take, and it all depends upon age. I always think of it really simply as if you are low in age, you should be high in risk. Now, if you are high in age, you should be low in risk. What I mean by that is if you are young, go and invest in high growth stocks, ones that are a little bit riskier, but will pull a bigger return. And that's because you will have a lot of time in your life to make up for those downfalls. Now, if you are high in age and you are going to be retiring soon and you need that money in the near future, you should be investing in low risk stocks so that you can maintain the principal balance on your investments and be able to use that in the near future. Now, if you're thinking to yourself, well, crap, I'm not 20 anymore, I should have started investing, there's no reason to stress out about it. The best time to start investing is today. I have two big rules when it comes to investing, and rule number one is to not invest money that I need in the immediate short term. So what I mean by that is if I have a mortgage payment coming up, I'm not going to go and invest that money a week before my mortgage comes due, because if things tank, like if I had invested in Bitcoin recently and it dropped 50%, well, then it would be tough to make my mortgage payment. So I don't invest money that I need in the immediate short term. Now, rule number two of investing is you can't be emotional. Emotional investors are investors that end up losing money. But on the positive side, for the rest of us, emotional investors also create opportunities for the rest of us. So if there's a bunch of people that start getting stressed out because a stock starts dropping and they get nervous and they start selling, well, that's going to drop the price even further, which can create opportunities for smart investors because they can go and buy that stock at a lower price and watch the appreciation happen. Now, there are instances when you should get out of a stock, like if a company has committed fraud or if they're going bankrupt or things like that. But if it is a well-established company and you start seeing a little bit of a dip in a market, you should really just hold, because it will rebound even if it drops for a while. I mean, even over future, you can see a trend line in the stock market where you'd have these big drops. You'd have like the Great Depression, you'd have the dot-com bubble, you'd have 2007, 2008 housing crisis. Those created some giant drops, but it also went way up. So we're at like record level stock markets, and it's a great thing. So if you see those dips, don't get nervous. You should just see those as opportunities to get more established in the market and to buy more stock. And doing this consistently is what's called dollar cost averaging. Essentially, you're just consistently buying in the stock market. Now, at times you'll end up buying at the peak, but at other times you'll end up buying at the dip because you are buying consistently. Now, over time, that averages out your price, but you'll see the appreciation and you can have great returns in the market. In my case, I do a lot better when I just invest consistently over time than when I try to time the market, because timing the market is insanely hard to time it perfectly. There's no way that I could time it perfectly to buy the dip every single time and then to sell at the high every single time. So what I do is I just make sure that I am consistently putting into the market, and then over time I see great gains. All right, now let's break down the avenues that I would use to invest. And the first thing that I tell most people to do is to open a health savings account. I love health savings accounts because they give you tax benefits now, and they give you tax benefits later when you withdraw it for a medical purpose. Now, we are all going to get older. We're all going to have medical needs. So if you start contributing into a health savings account now, you can save yourself a whole lot of money. The annual contribution limit to a health savings account is $3,600 as an individual and $7,200 as a married filing jointly. Now, you can contribute that every single year, and I can pull that money out tax-free anytime as long as I'm using it on a medical expense. Ever since I've been married, I've been contributing into a health savings account, and that has really started to grow. And you can actually invest the balance that you have in your health savings account. You can also use it for medical expenses, which I do. Now I can always pull that money out completely tax-free for a medical expense. And when I contribute it pre-tax. That means I'm not taxed on that income during that year. So it saves me money in taxes today, and I can pull money out later tax-free, which is awesome. There is very rarely an investment opportunity like at HSA. Now, honestly, my next favorite investment, the thing that I focus on personally, is real estate. And I know that takes a little more capital to get a down payment to buy a rental property, especially in a housing market like the one that we have now. But there are ways to do it. You can house hack, which I've made videos on, and you can invest in real estate. And I love it because, one, you can write off the depreciation on that property and save money on taxes. But I also feel it is a very secure financial investment because you can have renters and they will pay your mortgage for you. You get that cash flow, but you also get the appreciation of the property as the market continues to go up. All right, next, what I would tell you to do is to contribute into your 401k. Now, if your company has a 401k, you should at least be contributing enough money that you can receive all of your employer match. Usually an employer will give they'll match something. So if you say, hey, I'm going to contribute 3%, they might say, okay, we'll match it up to 1.5%. So they could match whatever you put in. You should max out that match and get as much as you can in there to receive that match. Otherwise, you're just throwing free money away, which is obviously not a smart choice. So invest in a 401k, and in 2021, you can actually invest over $19,000 into a 401k completely tax-free. So that means you will not be taxed on that income in this year, which I like because I like to save as much money on taxes and keep as much of that tax money in my pocket instead of the government's. Now, if your company does not offer a 401k, then go find a traditional IRA and get one of those, because that is another way that you can contribute tax-free money into a retirement account. Contribution limits for an IRA are $6,000 as an individual and $12,000 as a married filing jointly. A traditional IRA is like a 401k, so you actually contribute the money pre-tax. That means you are not taxed on that income in this year, which is awesome because you save taxes. Now, the other option is a Roth IRA. That is where you actually contribute post-tax, but when you go to pull that money out, it is pulled out tax-free. Now, traditional IRA, when you pull that money out, that is when it's taxed. I still like to save the money now on my taxes, but a lot of people like to have that tax-free pulled later, and so you can do a Roth IRA and pull the money later completely tax-free. Once you've done all of those and you still want to invest, then you can go and find a regular brokerage account. You could open up a Robinhood, you could open up an account at Charles Schwab, you can do Webull. There's a bunch of different avenues that you can go and invest money. Now, at this point, all the tax benefits are gone. You're not contributing pre-tax, And you're also, whenever you sell, you are also going to be taxed on that, and it'll either be regular rates if it's something that you've held for less than 1 year, or capital gains if you've held the stock for over a year, but when you pull that money, it will be taxed. Now, those are all the avenues, not all of them, but there's a good chunk of them, the ones that I would suggest. Now, if you have any other questions, please hit me up in the comment section. I would love to answer any personal finance questions or investing questions, and we'll catch you guys next time.